This is actually borne out in that website towards the end, where it actually talks about money management, as we can see here. And we can see from the top line here, money management is the most important aspect of a mechanical trading system. And then a little bit further, yet the interplay between entry signals, exits, and money management is often non-intuitive. Study and research into the state of the art in money management will pay enormous dividends. I think this emphasises something about Donkey and breakouts, and the turtle system itself is actually the entries, and also to a certain extent the exits, are not particularly important. What is incredibly important is the money management rules associated with it and the position sizing associated with it. The turtles themselves admit that even using the system in its complete format, you would need to have a large account size. The account size that were given to the original turtles were between $500,000 and $2 million. This would enable them to trade a wide breadth of market and also allow them to have position sizing not only based on the account size but also in the correlation between different markets. Even with all of this, it's also possible to have very large drawdown durations. And as they say in this particular website, it's possible to have a drawdown duration of up to 2 years. Well, this means for the non-professional trader, and even the professional trader if this was their only methodology, that really, can we sit underwater for up to 2 years and stick with the program and stick with the trading system? The answer for most people, not surprisingly, is no. But this does not mean that this particular methodology of trading is not still hugely popular. The reason for this is that it can be part of a much wider scheme or part of a wider suite of trading methodologies. And this is why I've had to build it for so many banks and hedge funds and institutions over the years. However, if we're not a bank or a hedge fund that has many traders or many different methodologies of trading, then how are we going to try and make Donkey or turtles work? In my experience, I've only actually met one individual who I know made consistent money out of the turtles, and even then he was somebody of considerable wealth, and more importantly had worked out the importance of position sizing and correlation and automated those methodologies into an Excel spreadsheet. And so therefore what this meant was that his asset allocation, whether it was in foreign exchange or bonds or commodities, was always balanced in relationship to volatility and average true range of those particular markets. Even then, with all those sophisticated tools, it was still down to his ability to trade the position well and also have the discipline to stick to the rules. And as he said to me, even with all of that, his accuracy was still pretty low at around the 20 to 30% mark. Here I've just placed this turtle system on the German interest rate again, and we can have a quick look at the statistics and give ourselves an idea of what we need to do when looking at the profits and loss of this particular system. We can see that overall the system has made approximately We can see that overall the total net profit on this system has been around $100,000 over that 8-year period, and that's just trading one contract at a time. Having said that, the drawdown amount at one point was nearly 80,000, so we've nearly at one point lost as much money as we ever made. The drawdown duration is around 15 months, where the system was not making money or not making new highs. And we can see that the percentage accuracy is around 41%, and we're currently in a drawdown that's lasted 42,000 euros. I've now put that same system on the S&P E-mini, and here we can see that actually over the period, in spite of there being some decent trends, I would have thought, it's actually lost $170,000 over that time. Has had a drawdown duration, not surprisingly, of getting on towards 4 years, and is only accurate 30% of the time. This emphasizes the fact that we really need to have a very broad brush, so we need to be trading lots and lots of different markets so that we smooth out the profit and loss associated with this particular system. Now I've placed it on the euro dollar against the US dollar FX rate, and we can see in this particular case it has made money over the period, although the drawdown amount is greater at one point than what the overall profit was. And we can see yet again that the accuracy is quite low at 36%.